Welcome back to the deep dive. Okay, get this. India's retail inflation just hit its lowest point since January 2019.
Yeah.
That sounds like amazing news, doesn't it?
Yeah.
But, you know, as always with economic data, the headline, well, it's just the start.
Absolutely
There's
right.
always more going on underneath.
What's fascinating here is that, yeah, while the headline figure is certainly positive, really digging into why it's so low
Yeah.
and what other sort of underlying trends are at play, that reveals a much more complex picture, a really insightful one, actually.
Exactly. So our mission today is to, well, dive into a recent economic update. It's got all the hard data, the nuanced analysis.
Right.
We're going to take these figures, try to break them down, and show not just what happened with India's retail inflation in June 2025, but crucially, why it matters. For your daily life, your financial decisions, let's really get into it.
Indeed. We'll be scrutinizing the figures, trying to truly understand the forces at play, and, importantly, what they signal for the economy moving forward.
Okay, so let's kick things off with that headline story, because it really is significant. The Consumer Price Index, CPI, right?
Yeah.
It eased sharply to just 2.1% year-on-year in June.
2.1%, yeah.
That's way below what most analysts expected, and like you said, the lowest since January 2019.
And it wasn't just a one-off blip either. That's a crucial point. We actually saw back-to-back easing.
Oh, really? Both rural and urban?
Both rural and urban inflation eased, yeah, which suggests it's a more systemic moderation, perhaps, taking hold.
Okay.
And if you zoom out a bit, look at the quarter, Q1 FY26.
Yeah.
Inflation has come in at 2.7%.
2.7, lower than the RBI expected to.
Lower than the Reserve Bank of India's projection, which was 2.9%, and much, much lower than Q1 of the previous fiscal year, which was 4.9%.
Wow.
So that consistent downward trend, it's really notable.
So that's the big picture then, a broad cooling across the country.
Yeah.
But okay, the headline only tells part of it. What was the real engine behind this big drop? Where does the real story begin?
Well, the decline in headline inflation. Once again, it was primarily driven by food prices.
Food again. Okay.
Key categories like vegetables and pulses, they entered what economists call deep deflation.
Deep deflation, that term really jumps out.
Mm-hmm.
What does that signal economically when you see such big price drops in staples? Beyond just, relief at the supermarket?
It signals a pretty significant supply-side improvement. I mean, to give you a sense of scale, vegetable prices, they contracted by nearly 19%.
19%.
Yeah. Overall, food and beverages, year-on-year, slowed from 1.5% growth down to a contraction of minus 0.2%.
Minus 0.2, wow.
Which is its lowest print since that same benchmark, January 2019. And to be more specific, staples like onions, potatoes, tomatoes, prices just plunged.
How much are we talking?
Some by over a quarter, even a third. Onion prices down 26.6% in June.
Okay.
Potato inflation deepened further, minus 25.4%. And tomatoes continue correcting for the sixth straight month, down 31.5%.
Sixth month for tomatoes.
Yeah. So for anyone, tracking their monthly grocery bills, this is very, very tangible relief.
Incredible drops for everyday stuff. It's almost,
Yeah.
I mean, are these signals mixed? Is this concentration in specific vegetables maybe fragile, or does it point to something more stable agriculturally?
That's a good question. Out of 21 food sub-indices, only 5 actually recorded any growth for the month.
Only 5.
Only 5. Shows you how concentrated this deflation was. Now, looking ahead, the outlook for food inflation, it actually remains quite favorable.
Okay, why that?
Well, helped by factors like a monsoon that's, 10% above normal so far, healthy reservoir levels, robust progress in kharif sowing, that's the summer crop planting.
Right.
All strong indicators for a healthy harvest, which should keep food prices in check.
Okay, that makes sense. And what about other food items like cooking oils? I know those have been a worry for a while.
Yeah, good point. The oils basket did remain elevated, about 17.8%.
Still high then?
Still quite high, yeah. Mainly due to higher customs duty, which was put in place to support domestic production. This sub-index has seen double-digit price increases for 10 straight months.
Okay.
But there's some potential relief. The government recently reduced basic customs duty on imported edible oils.
Oh, okay.
And that healthy kharif sowing we mentioned, that should also help cushion these pressures going forward. So we could see some relief there eventually.
Okay, so food, Was clearly the massive story pulling down inflation.
Mm-hmm.
What else helped soften that headline number?
Well, the fuel and light index also showed some softening. It fell to 2.6% from 2.8% the month before.
Okay, a slight dip.
Slight dip. And this is interesting because it happened even though there were earlier hikes in LPG prices.
Right.
So it suggests maybe other parts like electricity or, petrol, diesel saw some easing perhaps.
And context here. Hadn't fuel been weirdly low before?
Exactly. For context, this index had actually been in negative territory deflation for 18 months before March.
18 months.
Yeah, then it recorded a 1.4% increase in March. So while it's still positive inflation now at 2.6%, its contribution to the overall number did ease back a bit.
Okay, so we've got food prices plummeting, thank goodness, and some easing in fuel. That's the good news side of the ledger.
Right.
But here's the twist, isn't it? The part that tells us not everything is cooling down. While we got relief there seems to be this underlying pressure building elsewhere. Core inflation.
That's exactly right. While headline inflation tumbled, core inflation, it surprisingly inched up to 4.4% from 4.2% in May.
How does that work?
Well, it reflects this persistent stickiness in services and personal care prices,
Okay.
which really underscores the demand-side impact, from earlier monetary easing, fiscal support. It suggests underlying demand is actually still quite robust, even while food prices are cooling things off overall.
But hold on. That feels counterintuitive. If headline inflation is dropping like a stone because of food, how can the core part, the underlying trend, actually be rising? Right. What does that divergence tell us about the economy's health, beyond just these sticky prices?
It signals that while those supply-side factors are helping massively on the food front, demand is still pretty strong in other sectors.
Okay.
So look at the miscellaneous group. It holds the second largest share in the CPI basket, about 28.3%.
Right. It's a big chunk.
It is.
Yeah.
And it grew by 5.5%. That's an uptick of 32 basis points, just over a third of a percentage point compared to May.
And what's driving that miscellaneous group increase?
The main drivers there are personal care and effects, where prices jumped by a significant 14.8%.
Wow, 14.8% in personal care.
Yeah. And transportation, which saw prices rise by about 4%.
Okay, and within personal care, what exactly is causing that huge jump in stickiness? Is it just everyday stuff like shampoo and soap, or?
It's a bit broader, actually. We're talking about items like gold prices,
Gold.
which have shot up by 36% and have been growing in double digits since January 2023.
36%, okay.
Silver also remains stable but high, 17.8% in June. And then things like tuition fees continue to add to that stickiness.
Tuition fees, right. That makes sense.
And there's always an upside risk on gold, isn't there? Especially with ongoing global economic uncertainty. People see it as a safe haven, pushes the price up.
Sure. Any other areas pushing core up?
Housing inflation also saw a slight uptick, up by 8 basis points, sitting at 3.24%.
So it's not just routine services then. It's these bigger ticket items or things like precious metals, education.
Mm-hmm.
They're keeping that core number elevated. But then you also mentioned earlier that the risks in core prices are seen as largely contained. How can both things be true? High growth in some areas, but contained overall.
Yeah, that's a critical point to get. The increase in core prices is considered largely contained because the growth isn't broad-based across all core items.
Oh, okay. It's concentrated.
Exactly. It's concentrated in specific areas like that personal care group, driven by those particular components, gold, silver, tuition fees. So it's not like everything non-food, non-fuel is shooting up.
Got it.
But it does raise that important question. Why this split? Why are food costs plummeting while these service and specific goods prices remain sticky? And what does that signal about the underlying economy?
Yeah, that is a million-dollar question, isn't it? So let's connect the dots. What does this all mean for us, for the listeners?
Yeah.
How should we read these signals for our everyday lives, maybe our financial planning?
Well, look, while that impressive headline number, the 2.1%, certainly strengthens the case for the Reserve Bank of India to keep supporting growth.
Right. You'd think it screams cut rates.
You might think so, but the persistence of these core pressures, that stickiness we talked about, it means the RBI will likely stay cautious.
Okay.
Which implies that, aggressive rate cuts, probably unlikely in the near term.
So even with headline inflation so low, you're saying rapid cuts are off the table. Does that mean the RBI sees this core stickiness as maybe a more significant structural issue than the perhaps temporary relief in food prices?
That seems to be the read, exactly. They appear to be taking a very measured approach. Further rate cuts down the line, still possible,
Okay.
but the pace of any cuts will likely moderate, especially if, say, new geopolitical tensions pop up or there are tariff shocks that disrupt the current stability.
Right, external factors.
Exactly. So for you, the listener, what this means is, while the overall environment seems to be cooling inflation-wise, don't expect a sudden dramatic shift in borrowing costs, for example.
Okay.
It suggests a careful, measured path from the central bank, and that impacts everything, right? From loan rates to investment returns.
It really is a classic tale of two economies inside one headline number, isn't
It
it?
really is.
On one side, you've got this agricultural bounty, seems like, pulling down overall inflation, giving us real relief on groceries.
Tangible relief.
But on the other side, you have these stubborn pressures in core areas, especially personal care, showing that underlying demand, or maybe specific costs, are still quite robust.
Precisely. And this isn't just, a statistical quirk. It's a fundamental tension playing out.
Yeah.
It shows that the fight against inflation, it's getting more nuanced for the RBI. It's not just a broad brush battle anymore. It seems more targeted now against these persistent demand-side pressures or specific cost pressures like gold, even as supply-side factors bring relief elsewhere.
Like the monsoon and crops helping food.
Exactly. That's been a huge blessing for food prices. But the stickiness in gold, tuition fees, it just highlights that some costs are simply less elastic, less responsive to broader economic shifts.
Which leads us perfectly to our final provocative thought for you today. This split, this divergence between plummeting food costs and sticky service or specific goods prices, it's not just about your wallet today. It might actually reshape how we think about economic recovery itself.
That's a great point.
Could this pattern, localized inflation in some areas, mapped by broad deflation in others, become a kind of new normal? Could it challenge how central banks usually operate? And maybe think about this. What aspects of your own spending might reflect these core pressures? Are you noticing prices still going up for personal care items, or finding certain services just aren't getting any cheaper? It really makes you think, doesn't it? Where your money is actually going and what's truly driving those costs, even when the big picture number looks incredibly positive.